With Donald Trump putting tariffs on allies, pulling support from Ukraine, and threatening the European Union, many European investors are worried about their US investments. People ask me, what if Trump crashes the US stock market? And in fact, he said he's doing exactly that.
We may have short-term a little pain, and people understand that.
From mid-February to mid-March, the S&P 500 dropped by 10%, and Elon Musk's Tesla fell by as much as 50% from its peak.
Everything's computer.
This crisis is especially painful for me because I'm European, but I learned to invest while living in America as a young banker on Wall Street 17 years ago. Today, I'm a professional investor here in Europe. I've invested hundreds of millions of euros for my clients, and even though it's hard to believe I'm saying this, in this video I will explain if you should sell your US stocks or ETFs, and I will show you 3 alternative strategies to consider instead. I have taught several 100,000 European investors over the past 4 years, and the single most popular question people ask me is, how do I buy the S&P 500? For many Europeans, investing has been synonymous with buying 500 of the biggest American companies. And for a long time, that was an incredibly profitable approach. But today, there are 3 serious problems with this strategy. First, the S&P 500 used to be highly diversified. Buying it meant spreading your money across many different companies. If one company got into trouble, it wouldn't harm you that much. But today, just 5 big tech companies, Apple, Nvidia, Microsoft, Amazon, and Meta, make up 25% of the index. Half of your money is invested in just 30 big American companies. If these companies get into trouble, you get into trouble. So the first problem is lack of diversification. The second issue is pricing. Over the past 15 years, since the financial crisis, the US stock market has earned an average profit of 14% per year. And that's amazing. It's high above the long-term average for the market. But this result didn't come because the US economy grew at fantastic rates, not at all. It didn't even come because companies suddenly became super profitable. A lot of this growth came simply because stock valuations went up. Investors became willing to pay more for the same level of company profit. In 2010, if you had a company earning $1 per share in profits every year, you would pay around $19 to $20 to buy that stock. Then the market started going up. By 2017, you had to pay $28 to buy $1 of profit. And that seemed crazy to a lot of people. I remember this clearly because we were starting the investment company Indexo here in Europe. And a lot of people didn't want to invest in our company because they thought the stock market was about to crash. It was just too expensive. But then for the next 8 years, stock prices kept going up and up and up. And today in the US market, you actually pay around $35 for $1 of corporate profits. So that's almost twice as much as back in 2010. By contrast, in the European stock market, you pay $21 to buy $1 of profits. In Canada, it's $25. In Australia, it's $22. So American stocks are simply a lot more expensive than in all other markets. And financial theory tells us, when you buy stocks at higher prices, your expected future returns are lower. That's either because there's going to be a crash or because the market will simply grow at a slower pace. Now, there are counter-arguments to this. Many people say that the US market is dominated by fast-growing tech companies, and that justifies the high stock prices. But the fact is, US stocks have become very expensive compared to historical averages. And the third problem is the Trump effect. His policies pose very real risks to the US economy and to European investors. As any economist will tell you, when you put tariffs on your trading partners, you don't just harm their economies, you harm your own, because imported goods become a lot more expensive. And when you start firing thousands of government employees, well, suddenly there are a lot of people who are afraid for their future, and scared people don't spend money. This can easily start a recession. And that's before we discuss the devastating impact of America losing the trust and friendship of allies all around the world. In fact, I haven't felt this concerned about the US stock market since the great financial crisis back in 2008 and 9. To me, even COVID was a lesser issue because pandemics only last a few years. Everybody was freaking out in early 2020 when the market crashed, but at my company we just stayed calm and kept investing as the market went down and then back up. And that turned out to be a really profitable strategy. But today, the changes that Trump is making to America and to the world, well, these changes might last for generations. This is history being made, and it will affect stock market profits for decades. All of this makes European investors justifiably nervous. But does that mean that you should sell all your US stocks or ETFs? Well, not so fast. There are strong arguments against it. For one, the American stock market is still the biggest in the world, with the biggest companies serving clients worldwide. Investing in the US market gives you a level of diversification that is hard to replicate anywhere else. Second, historically, the US stock market has been unstoppable. Over the 20th century, American stocks earned 10% per year on average, compared to 8% for global stocks. And over the past 50 years, American stocks have also outperformed. And third, the US has a strong entrepreneurial culture. I spent 8 years living in America, and I've never met as many people who are good at making money as I did over those years. The US has a lot of smart, motivated entrepreneurs, relatively low levels of regulation, and many of the world's most innovative companies, especially in AI today. There is a reason that Warren Buffett says, "Never bet against America." And finally, even the Trump effect is hard to fully predict. Yes, his tariffs and policy swings could pull the US into a recession. In fact, I would say it's very likely to do so in the short term. But long term, it's possible that Trump's push for deregulation and lower government spending could drive better economic growth. And even Trump's tariff strategy could have some unexpected positive consequences. The economy is an incredibly complex system, which is hard to predict. So here's why I'm not rushing to sell all my US stocks and ETFs. Back when I was the investment manager for Indexo, our investment company, I was responsible for investing hundreds of millions of euros for many future retirees. And whenever there was bad news in the press, which was almost every month, I was tempted to try and time the market, to pick the best moments to buy and sell so that I could protect our investments from all kinds of risks. But I knew what decades of research say. This kind of market timing, it simply doesn't work. The market goes up when you expect it to drop, and it drops when you expect it to go up. You end up selling and buying and making moves at all the wrong times and wrong prices, and you lose money. So even though it was scary, I just stuck to our strategy. The market went up and the market went down, and I just kept investing our clients' money in a diversified global portfolio. And long term, this worked out great. That is how we got our pension clients the best investment results in the whole country. That's why today I'm not changing my long-term strategy because of this current Trump situation. My personal portfolio is invested in thousands of different stocks all over the world. A big part, around 60%, is invested in American stocks, and I'm not changing that. I know the US market could drop tomorrow, and that's fine. I'll just keep investing and stick to my strategy. But I will say this. If you are 100% invested in only American stocks today, if all your portfolio is just the S&P 500, I would think very hard about what you're doing. If there is one consistent theme in academic research about the stock market, it is that diversification works. It is the only free lunch in investing. With diversification, you lower your risks without harming your long-term expected profits. So let me show you 3 strategies for doing this. Strategy number 1 is international funds. So let's take a look at just how that works. I use justetf.com when looking at different kinds of ETFs. So for example, here we have the iShares Core MSCI World UCITS ETF. And this is not an investment recommendation, it's just an example. This is a fund that invests in developed world stocks. Okay? So that's countries like the US, the UK, Canada, Europe, Japan, Australia. And here, if we scroll down to the section holdings, we will see that with a developed market fund, 70% of your money is invested in the US, and around 30% is invested in other countries. So that's still a very significant investment in American stocks, but it's meaningfully diluted compared to just buying the S&P 500. If you want something even more diverse, you can look at what's called all world stocks. So instead of just picking developed markets, you can also add emerging markets, such as Brazil, India, and others. One such fund would be the Vanguard FTSE All World UCITS ETF accumulating. Okay? And if we look at this fund's holdings, we see that around 61% is invested in the US market. Now, this is very similar to my strategy. I use a different all-world fund to invest in the whole world. This kind of approach has been less profitable over the past 10-15 years because you would have been better off investing just in America. But I prefer it. I'm happy with it because I have a very diverse approach. And if one region struggles and another one does better, on average, I'm likely to be fine. The second strategy to consider is not just about geography, but also about company size. If a significant concern is that too much of your investment is concentrated in a few large American stocks like Apple and Microsoft, you can consider investing in small cap stocks. These are smaller companies, and historically small cap stocks have performed very well, even though the price swings tend to be a bit bigger than for the market as a whole. So, for example, when we looked at this MSCI World Fund, so this was developed world stocks, it invests in mid and large sized companies. So in the holdings section, we see that the biggest stock is Apple with 5.5%. Then you have Nvidia with 4.8%, Microsoft with 4.3%, and so forth down the line. But if I look at an MSCI World Small Cap ETF, this invests in small companies. And here we see that the biggest constituent Interactive Brokers Group is just 0.25% of your investment. So you're not exposed to any single company. Your money is spread among many different stocks. Now, of course, just investing in small caps does mean that you miss out on any potential growth and benefits from larger companies. So sometimes people prefer what are called investable markets funds. For example, this SPDR MSCI All Country World Investable Market ETF invests in all company sizes, ranging from small to medium to large cap. And arguably, this is the most diversified approach to investing globally that you can find out there. And the third strategy I want to look at is using ETFs that exclude the US stock market. I know that there are some investors out there who are so concerned about US stock prices, or maybe who dislike Donald Trump so much that they simply do not want to invest in America. And if that's your choice, that's fine. I can respect that. So let's look at how you can accomplish that. Now, this used to be quite difficult, but fortunately, there are now a few ETFs in the market which do this. For example, there's this Xtrackers MSCI World X USA UCITS ETF. Okay, so this invests in developed world stocks, excluding the American market. If we look at the holdings, we see that the biggest countries are Japan, the United Kingdom, Canada, France, and others. And here the biggest stocks are Novo Nordisk, ASML Holding, and SAP. Now, if you prefer a more custom strategy, if you don't want to just invest according to the size of different markets and put 20% of your money into Japan, then you can also make a custom portfolio. You can buy a European ETF, a Japanese ETF, a Canadian ETF, and make your own combination. But the problem with this is that it's difficult to choose the right proportions. It starts to be more like active investing. It's almost as difficult as stock picking, and it can be hard to choose a good strategy and then to keep it up over time. I would recommend choose a strategy that is as simple as possible and that you can maintain for the next 10, 20, 30 years. Okay, so this is a difficult time in the market, but no matter what strategy you choose, I would say this. It's almost never a good idea to give in to fear and stop investing. In the short term, it can seem less risky because you avoid losses. But over the long term, it is guaranteed to keep you poor. Your money will just sit in a bank and lose value to inflation. Trump is not a good excuse to stop investing. And high American stock prices are also not a good excuse. You can deal with either problem by diversifying or, if you prefer, avoiding the American market. Now, obviously, this situation is changing quickly, and if you're not a professional investor, it can be hard to keep up with the news and figure out what it means for the markets and what you should do with your investments. So if that sounds familiar, you might want to subscribe to my free newsletter for European investors. In this newsletter, I cover useful investing insights, updates about the market, my views on what's coming next, and what we can do about it as European investors. So if that sounds interesting, you can sign up by following the link in the description.